Welcome back to OptionFlow. I'm Lou, OptionFlow founder. I am a high-ticket mentor. I teach investor my method, my strategy, my step-by-step investing strategy to create or improving a stream of income, investing your own money in any market scenario with few hours a month. So I teach exactly what to do, a step-by-step strategy for beginners. Okay, so you can invest, creating a real stream of income, monthly income. Okay, so I work with few selected investors because I am a businessman, I am an investor, so my time is limited, and that's why I teach only few investors, just a few spots every month. So, disclaimer as usual, I'm not here to suggesting you what to do with your money, how to invest your money. It's your business, your responsibility. I don't care. This is my personal blog. Okay? I share my own ideas, my way of thinking. I share what I do with my money. So what I believe, what works for me. Okay? So I want just to inspire some of you who want to invest knowing exactly what to do, because every course, everybody teach good theory. It's great, but I like practical things, step by step. Do this, and do this. So it works for me. That's why I created my OptionFlow method, and this is what I teach. I teach what works for me, for my lifestyle, for my beliefs, so how I want to live my life. So in today's video, we'll delve into two popular option strategies: covered calls and cash secure puts. In the previous video, I talked about long calls and long puts, the two basic strategies. Today, we see something more. Okay, so covered calls and cash secure puts. So we'll provide a detailed overview of each strategy, discuss their benefits and risks, and explore how to implement them if you want to use these strategies. Okay, so let's jump right in. First of all, let's examine the covered call strategy. Okay, here in investing in tradingview.com, I selected SPX. Okay, so just an example, or you can see SPY ETFs. Okay, so let's make an example of a covered call. In a covered call strategy, an investor sells call options against shares of stock or ETF, in this case, they already own. Okay, so one option control 100 stocks or 100 ETFs. It means that, for example, you have in your portfolio 100 SPY ETFs. Okay, as an investor, you can use this strategy, a covered call. So this strategy generates income from the premiums collected from selling the call options, providing some downside protection if the stock price declines, but capping the potential upside if the stock or ETF, the underlying price, rises above the strike price. Okay, so let's make an example. SPY ETF. Okay, so in this example, the investor owns 100 SPY ETFs. Okay, so this investor wants an extra income. Okay, so decide to sell one covered call. Okay, at a higher price, for example, $530. Okay, every month, every 30 days, more or less, sell one covered call. Okay, so for example, this month, $530. Okay, so it means that this investor collect premiums received every month from this call sold, because already own the ETFs. So, for example, for this $530, it's, I don't know, $20, but just an example, okay, to make it simple. So it means that if the price rises, of course, the ETF increase its value. Okay, so he has 100 ETFs, so ETFs increase the price. The covered call, after 1 month, this investor keeps the premium if the price would be under $530. Okay, so this is a good strategy to generate income if the market is sideways, for example, a little bit bearish, a little bit bullish, but not the strong bullish market. Okay, so this is how it works. Let's explore the other strategy, the cash secured put strategy. In a cash secured put strategy, an investor sells put options while holding enough cash in their account to purchase the underlying stock if assigned. So in this case, the investor doesn't have the 100 SPY ETFs, but he has the money to buy 100 ETFs if assigned. Okay, so this strategy allows investors to potentially acquire stock or ETFs in this case at a lower price or the put option strike price, while generating income from the premiums collected from selling the put options. So let's make an example. The same investor doesn't have 100 SPY ETFs, but he has the money in his account to buy the ETFs. But he doesn't want to buy 100 ETFs at $500. He wants to add 100 SPY ETFs at $480, for example. Okay, so he decides to sell one put, $480, expiration date 1 month. Okay, so his strategy is, okay, I want 100 SPY ETFs, but I don't want them at 500. 500 is too much. I want at $480. So rather than patiently wait, because he doesn't know when ETF SPY would be at $480, he decides to sell one put every month, so collect premiums. So if the price will be above $480, he continues to collect premiums month after month. If the price goes at 480 or under, he has the right to buy, to be assigned, so to buy 100 ETF SPYs at the desired price, $480 in this case, plus all the premiums collected before for the patients. Okay, so there are two different strategies. So let's consider the benefits and the risks associated with covered calls and cash secured put. Both strategies offer potential income generation through option premiums. Both can sell calls and puts on a weekly basis, on a monthly basis. Okay, so it's a protection and income generation. Okay, with relatively low capital requirements. Okay, so these are the benefits. What are the risks? The main risk of covered call is the potential opportunity cost if the stock price or the ETF price rises sharply above the strike price. If the price skyrockets, it's a risk. Okay. For cash secure puts, the primary risk is the obligation to purchase the underlying stock or ETF at the strike price, which could result in losses if the stock price declines significantly. So in this case, the investor should have the cash in the account to buy 100 stocks or 100 ETFs. In this case, if the investor wants 100 ETFs, $480 for one ETF, it means that for 100 ETFs, the account should have at least $48,000. Okay, so it's a big amount of money just for one strategy. Okay, so that they are two different strategies with two different scenarios. Okay, one, the investor already has the underlying and want an income generation. Okay, in the other strategy, the investor doesn't have the underlying but wants to buy the underlying at a lower price and already has the cash in the account to buy the underlyings. So I don't use these two strategies, but if you want, for example, or if you are investing in the long term stocks or ETFs and you want generating an extra income, so you can use one of these two strategies. Okay, so remember to conduct thorough analysis, manage risk effectively, and stay disciplined in your approach. Okay, because these two strategies, they are not for everyone. They are for a kind of investor with their own strategy. So I don't use these two strategies, but that's here what you can do. Okay, if you want, for example, an ETF or a stocks and you want an extra income generation, but do your own research. I do not recommend you to use these two strategies. Okay, but if these strategies could fit something you already do or you want to do, and you see an extra income from doing what you like, how to like to invest, what you like to do, here these two strategies could be for you. I don't personally use these two strategies because I want to be non-directional investor. Here the investor is directional because wants the underlying, or already has or wants the underlying, and having an underlying, an ETF or a stock, it means that you can earn only if the price is higher than the price you bought, period. Okay, I am not directional, I am a non-directional investor, and because I don't want to be involved with an underlying for the following 5, 10, 20 years. Okay, that's why I teach investors how to generate income without having one or more underlyings for years. Okay, because the market is changing, market is going to change a lot, and lots of times, and violently, in my opinion, in one way or in another. It doesn't matter. So I think, and this works for me, to be prepared in any market scenario with one precise strategy. This is what I teach to my investors. So thanks for watching this video. Don't forget to like, subscribe and share this video with other traders or investors. Stay tuned for more insights from OptionFlow, and if you want to know if OptionFlow method could be a good fit for you, below this video there is a calendar link. You can click and book a free consultation call with me, so you can see in your specific situation if it could be a good fit for you. I work with only few selected investors, so I'm not for everyone. I don't have time. So that's why we can see if it could be good for you and you can be a selected investor I would like to work with. Okay, so until next time, happy trading, happy investing, and see you on the next video. Bye.